Now, notice this is called the Helpful Society. And I just wanted to bring one thing up here. Not-for-profits do not have to be these. They can be societies which don't receive charitable donations. So the distinction between those two things. A not-for-profit does not have to be a charity. So all charities are not-for-profits, but not all not-for-profits are charities. Okay, so we've got our statement of financial position, or our balance sheet, however you want to think of it. And we've got the usual cash, and notice it's in two different columns or funds. Pledges receivable. So pledges are amounts that people pledge to give. So I don't know if you're in the malls around Christmas, there's often not-for-profits set up. Now, they know people don't have a lot of money to spend at Christmas because they're buying gifts and so on. So sometimes they'll ask for a pledge. So in the new year, by the end of February or March, you will give $100 or whatever you want to give. Those are pledges. So there will be a pledges receivable account. Now, do you expect to get 100% of those pledges? Probably not. So you can set up an AFDA, allowance for doubtful accounts, for pledges. And the large for-profits will definitely have that set up. So we've got all our assets and the total. We've got some investments. No pledges receivable for the building fund. Then we've got liabilities and fund balance. Of course, we can't say shareholders' equity because there isn't any. So accounts payable and accrued liabilities go there, and then the fund balance. So this replaces shareholders' equity. And this wording is used for restricted funds. And sometimes they just call it fund accounting. So that's the balance sheet or statement of financial position. Very similar to what we're used to, just some changes in names. Here's our income statement. And tack on the changes in fund balances, which is your statement of retained earnings. Okay, so we've got the revenues, we've got contributions from people giving stuff, interest, we've got a total. We've got expenses broken down by program. And you will often see at board of directors meetings and so on, not just these statements, but pro forma statements that focus on what specifically you want. So if you had funding up here, contributions for just program A, you'd probably have another little statement for the board that had the net program A has. Okay, but our formal financial statements don't have that. Then there's fundraising, what went out, costs for fundraising, and miscellaneous expenses. Then you get the total. So here's our excess over expenses, which is like net income. Then you have the fund balance from January 1st, so that would be like beginning retained earnings. And then you get ending retained earnings. So the format is different, but it's like the statement of retained earnings. Okay, so basically we're taking beginning retained earnings, my goodness, adding the net income to get the end retained earnings. What's missing? Dividends. We don't have dividends because we cannot distribute to others. Hopefully that makes sense. Okay, if you want to turn then to the next page with the blue writing on it, this is from Appendix 12A. And this is an actual statement from the United Way, I think in Ontario. Deferral method. So this is the other method. And don't worry, we're going to get into it. Again, sorry it's so small, and I cut off the title. It should be the United Way. Okay. So, notice there's no different funds. It's all in one column. And we've got cash, pledges receivable. Again, you could have some type of AFDA account. Accounts are prepaid expenses, normal accounts, long-term assets, investments, tangible capital assets. Then we get our total assets. Then we get liabilities and net assets. Current liabilities. Now, these deferred accounts. So they're obviously liabilities. Deferred means there's some kind of restriction on them. And so we will record revenue when we incur the expense. So, let's say you got some money this year and it's for operations next year. Well, you can't put it into revenue this year. You have to put it into deferred revenue. So that's very similar to what we did with corporations. Okay, long-term liabilities, deferred lease inducement, same idea, it's deferred. So some kind of revenue to help them with their lease. Sorry, I just have to autofocus here. And then we get our net assets. Again, this replaces shareholders' equity. And notice the wording, it's called net assets. The wording is for deferral method. Now, remember, you are going to have exams as open book. So you don't have to memorize these, although you should be very familiar with the format. Some of the, is it called net assets or is it called fund balances? What is it? You can flip back and look at this. Just remember though, as we're going through the notes and you're practicing your examples and stuff, as I mentioned in your earlier video, you do have to make sure that a train of thought. Yes, this happens in the classroom as well. You do have to make sure you're prepared for the exam as if it were closed book. Okay? So make sure you understand it, because you do not have time in these exams to go back and look stuff up and go, oh, what does this mean? You've got to be ready as if you didn't need your books. Okay? Okay, so here's our net assets. The unrestricted, used for anything. Internally restricted, we already talked about. It's by the board. Here's the tangible capital assets. Okay, they could have just been lumped with unrestricted net assets. Remember, there were 3 options, but these guys separated out like most of the big ones do. And then here's the endowment that we've talked about. And then if you had any commitments, contingencies, and guarantees, they'd be listed there. We're not going to worry too much about those guys. So this part is the statement of changes in net assets, like statement of changes in equity. So that'll kind of tie the two things together, what you've already learned with the stuff. Okay, I'm going to stop the recording here, and because I've got limited time on here, my recording device, so we will start section B on page 2 when we get back.